has said so far in English. I'm just teasing. We joked about this before.
Yes.
I said, Donald is one of those people that has a personality. I mean, this is a rare. But here's the thing.
That's probably why I left the IRS.
Right. Here's where we're at so far. As soon as you started in doTERRA, you became a self-employed person. And if you have not filed with the state and created a business, a formal business with the Secretary of State, then you are a sole proprietor. And you are responsible to pay the taxes yourself on that income. Your employer is not taking it out of your check. And so what Donald has led us up to so far is, what does it look like now when you start to make enough money that it matters? And as soon as you're beyond $600, you become responsible for self-employment taxes. And then as soon as you, is that right?
Yeah, self-employment tax kicks in at like $800, whereas income tax doesn't kick in until around 12.
Right. So as soon as
12,000. Sorry, 12,000.
And you've made a $50 check from doTERRA, or you've made a $100 check. Probably by the end of the year, that might accumulate to $800 or so, or 800 or 1,000 as you get through the year. And now you're starting to get in a position where taxes are going to be your next concern. And so the Rod rule here: thou shalt not do thine own taxes. Okay?
Yes, that's a good rule.
This is why we brought in accountants, because we want you to understand that the best thing you can do as a new person stepping into the business realm is hire a firm like Donald's, so that you make sure that all these questions are being answered for you. Like I hired their firm, so I don't have to worry about a lot of these things. They answer these questions for me, and then they guide me on my expenses as I review those with them, probably twice a year.
Right.
And then the question is when do the entities become serious? My guess, I'd throw out $1,000 a month. Maybe is that when you say when should I worry about a business entity?
I wouldn't worry about a business entity really until you get to about 20,000 or so.
In total year.
Yeah, because you're not the one creating the product, so liability protection is not a question. It doesn't change your tax status at all by picking up an LLC. Not until you file as an S corp would you change anything with your taxes. So,
did I summarize that well?
Very good. Yeah, so you're at a different level. The idea is to create something so that what you're taking back from the government covers any expenses of a professional doing it for you and then some. So it's as if the government themselves are paying for you to have your taxes done. Let me move on really quick, and then because I'm hoping to cover a few questions, and then we'll go back to some of the questions if I can. So like I said, you're just switching self-employment tax now for payroll tax, but you only pay on what you take as a wage, as opposed to on 100% of it. So really quick, and I've got a couple summaries later in there. Let's just throw in some numbers. If I said, just to draw it out, I made $50,000 here, I'm going to pay income tax on that. Okay? Same thing over here. With the S corp, I've got $50,000. I'm going to pay income tax on that. So there's no difference income tax-wise. On that same $50,000, you have a duplication of tax because you're paying self-employment tax on that same amount of another 15.3%. Whereas on an S corp, you're not. So, and I know you probably can't see that over there, but on that S corp, you're not.
The translation, that's a lot of money.
So then if you take a wage of $20,000 on that, and you've got a W-2, you pay 15.3% on that amount. On the $30,000 that you didn't, you distribute that money to yourself because you're the owner. So this is like having stock, and you have your profits at the end of the year, and you're benefiting from those profits. That $30,000 you take, and it's just income tax, no self-employment tax. Oh, you want to push play on there, Caleb? Oh, we'll do the video and then we have a couple questions.
Why do you wait You got the risk of sounding a little funny. Oh, help! Does anyone have a calculator? Myron? Oh. You look at those morons. I paid my taxes over a year ago. What is this, sweetie? Did you see a scary picture in your picture book?
That was last year's taxes. You have to pay again this year.
No, because you see, I went ahead and year one, I was coming forward from the last previous. No!
I got a tax form on how to do file a month ago.
I have a to-do pile? March, how many kids do we have? Oh, time to count, I'll just estimate. 9.
3 of them have.
Shut up, if I don't hear you, it's not illegal. Oh, business kids! Here you go, eat easy nuclear power.
Homer, I paid that for you.
Okay, Mark, does anyone ask? You require 24-hour nursing care. Lisa's a clergyman. Maggie had 7 people, and Barbara's wounded to Vietnam.
Cool.
Well, see, it's not illegal.
So I thought Homer's a perfect example of how to do your taxes. So this gives the same scenario on there. So on the left side, you have no S Corp. On the right side, you do 50,000. You pay income tax on it, whatever your bracket is. So if you have combined income, it could be higher. And then that same 50,000, you have self-employment tax of 7,650. So if you did a wage or a W-2 of 20,000 on that, you'd pay payroll tax of 3,060. So you can do the math there on your difference, and you get about, what is that, $4,600 difference in what you're going to save. So there's a big difference there just on that. Yeah.
Do you have to file a separate tax return for your S Corp and then personally?
Yes. So you file an 1120S informational return. It kicks out what's called a K1 to your personal return, which is a summary of the earnings of the S Corp, and you get taxed at the personal level for that amount. So that's why on that 1040 it showed line 7, you would have 20,000 for a W-2. Line 17 would be your K1 amount from the S Corp, that's 30,000, and that's how you get your 50. So your income tax would be pretty low on that too, because you have your other deductions. Yeah.
I'm not sure how to ask it, but on the S Corp, where you wrote that, it looks like you're paying income tax on 50,000 plus 30,000, whereas on the LLC, you're only paying income tax on 50,000.
Sorry, so this is your income tax line here. This is your self-employment tax line here. So you have duplication here. Over here, there's still duplication. You're paying 15% still, but only on the 20 instead of the 50. Whereas on this side, you're paying on the full amount twice.
But the S Corp gives you the reduction of your self-employment tax.
Right, so they both protect you asset-wise. But we talked about how you can be an LLC filing as an S Corp or an S Corp filing as an S Corp.
Just based on the previous question, it made it sound like an S Corp separate and different from an LLC. An LLC
It
can
is.
be treated, it is, as an S Corp, but you can have an LLC be treated as an S Corp.
Right, we talked about that. Maybe, I don't know if you were in here or not at that point, but we were saying you could do an LLC filing as an S Corp or an S Corp filing as an S Corp.
Right.
Why would you do that? Why would you do an LLC and file an S Corp versus just being an S Corp?
Some people do it for the simplicity of it. When you're just starting out in a business, and not typically in this kind of business, you might have an LLC because you need the liability protection, but it gives you no tax benefit. Then as you get going and you now need the tax benefit, you make that election, but without having to convert to an S Corp. It's an election with the IRS. Even as an S Corp, you have to make an election to be treated as one. Otherwise, you're a C Corp and you have all the extra. Yeah. That's now personal income. You can do anything you want with it. You've already been taxed on it. It's in your possession, so you can do whatever you want. Yeah. One more question here, and then we'll move on. It's almost done anyway, but go ahead.
What point does it affect when you take off the write-off, like your expenses?
Say that again.
The expenses, so if you, would all this happen before your expenses are taken out, or does that?
So this is after expense. Your wages, your deductions, all your write-offs are all part of coming up with that number. It could be anything, but I will say this. The benefit of an S Corp as well is it gives you some anonymity, gives you some liberties for your write-offs that you wouldn't normally have because it separates you from you. Where the IRS can scrutinize any individual tax return pretty easy. Now that it's on a separate return, there's just not as many qualified agents to be able to audit them, for one. Two, if you're doing it correctly with a professional, they're rarely going to look at it. If you've marked off that you're paying yourself a reasonable wage, they're not going to really look at those. That doesn't mean you're going to write off whatever you want, but there's liberties as far as you go. I'll say for Rod and a few other people, Courtney Moses is a client, Desiree, and I have a couple of our clients here. But as you go making more money, the IRS knows that as these types of businesses grow, there's certain lifestyle expenses that somebody else wouldn't be able to write off. So I'm not talking something extravagant like buying a boat and all sorts of things. It can get to that point, but they're lifestyle expenses. Massages, travel, different things. But you get to a certain point, I'll be very honest with you, just with what we looked at when I was at the IRS. When you're at a lower level, if you have any type of lifestyle expenses or what could be deemed personal, you're not going to be able to take it, plus you're going to get hit with penalties if you do. As you grow and somebody looks at someone like Rod and says, hey, I'm not just doing doTERRA now for the oils, it's because it's increasing my income and it's for the lifestyle, and you're picking up downliners because of that, they look at you and they say, hey, I want what he's got. I'm not just doing it for the wellness part, I'm now doing it for my lifestyle and everything else. You could get up to where you're making a few $100,000 and higher. Now the IRS starts to look at it and go, hey, as long as we can see a direct connection between your expense and deriving income from that expense, we'll allow that. And so there's more liberties with that as you get bigger. And that's when you are higher income, obviously. Yeah.
Okay, this has to do with health insurance. So when you're paying your, in my business, I've got my health insurance, so I pay for that, and that is I take that as a write-off.
Uh-huh.
And anything that's not covered, I take as a write-off. Like when I have to pay the 20% or whatever. Is that correct?
I'll let you ask that one to Ben after one of us out, because that's a little more specific to your scenario. There are different things with an S Corp as far as your SEP, IRAs, retirement plans. The idea is the IRS looks at you and they don't care if it's a legitimate expense or not. It's what they say is true. You could be sitting right across from them and validate your expenses, and they could still just say, I think that's bogus. In their mind, they think that you're trying to get away with something. They don't understand, well, why would I pay $1 for a 30% write-off? I'm losing 70 cents on that dollar I just paid. So why would I have a bogus expense? And hopefully that makes sense to you. But they look at that and go, well, sure, you're going to spend thousands of dollars just to have the write-off. They think that they don't even know how to think about it the right way. Okay? So the idea is to protect yourself. Have your S Corp, you want to also have somebody doing, as you get to a certain point, 50,000 and higher, now you want to have someone doing your accounting. Then you want to start shoveling more stuff off. The idea is let someone else focus on what they do best so you can spend all that extra time creating more income. And that's how the economy works well. So here's your bottom line right here that I can show you with your different types of income. So at 30,000, which is when you would get started with one, after expenses to your professional, if you looked at our expenses and what we charge per year, it's about $1,500 a year for your basic S Corp and payroll, tax return and payroll throughout the year. You'd pay about $1,500. So your net savings after that is $1,700. That's that $4,600 we talked about that you're now taking, you're paying us with it, and the rest goes back into your pocket. You're already shoveling that off to the IRS. You're just taking it back from them, paying us and keeping the rest. The IRS gets none of it, okay? As you get to 50,000, your net savings would be 40. The higher your income, the greater the savings. So it makes more and more sense as your income gets higher. And our philosophy is always just pay a little to save a lot. It'll take away your headache and it protects you from the IRS. Yeah.